You know what's fascinating? While everyone's been arguing about whether silver is just some doomsday prepper fantasy, something extraordinary has been happening in the shadows of the financial markets. And I'm not talking about some conspiracy theory here. I'm talking about cold, hard data that Wall Street doesn't want you paying attention to. Let me paint you a picture of what's actually going on right now. In the last 18 months, we've seen something that hasn't happened in over 40 years. The silver market is experiencing what traders call a structural deficit. That means the world is consuming more silver than it's producing. And we're not talking about a small gap here. We're talking about a deficit that hit 237 million ounces last year alone. Now you might be thinking, okay, so there's a shortage, big deal. They'll just mine more, right? And that's exactly what I thought too, until I started digging into the numbers. Here's where it gets really interesting. Silver production peaked back in 2016. Since then, despite prices going up, despite demand exploding, production has actually been declining. And there's a very specific reason for this that nobody's talking about. See, here's the thing about silver that makes it completely different from gold. About 70% of silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. So silver miners can't just decide to produce more silver because the price is going up. They're constrained by the economics of these other metals. And right now, with copper mines facing declining ore grades and lead-zinc operations becoming less profitable, we're seeing this perfect storm where silver supply is getting squeezed from multiple directions simultaneously. But the supply side is only half the story. Let's talk about what's happening with demand, because this is where things get absolutely wild. You've probably heard about electric vehicles and solar panels using silver, right? Everyone knows that. But what most people don't realize is the scale of what's coming. The solar industry alone is projected to consume over 200 million ounces of silver annually by 2027. That's more than the entire investment demand for silver was just 5 years ago. And it's not just solar. Every single electric vehicle uses between 1 to 2 ounces of silver. With EV production expected to hit 30 million vehicles annually by 2030, you're looking at an additional 40 to 50 million ounces of demand just from that sector. Then you've got 5G infrastructure, which requires significantly more silver than 4G. You've got the explosion in electronics manufacturing. You've got medical applications that are growing exponentially. But here's what really keeps me up at night, and this is something that very few people are connecting the dots on. All of this industrial demand, it's essentially permanent demand. When silver goes into a solar panel, it's gone for 25 years. When it goes into an electronic device, it's not coming back. Unlike gold, which sits in vaults and can be recycled efficiently, most silver used in industrial applications is consumed in such small quantities that it's not economically viable to recover it. So we've got declining production, we've got exploding industrial demand, and we've got this permanent consumption dynamic. You'd think the price would be going through the roof, right? Well, here's where the story gets really interesting. And this is where we need to talk about what's actually happening in the paper markets. The silver market trades on something called the COMEX, which is the Commodities Exchange in New York. And every single day, the amount of silver that trades on paper contracts on the COMEX is absolutely staggering. We're talking about trading volumes that represent multiples of the entire annual global production. In a single day, you might see paper contracts representing 500 million ounces of silver change hands. That's more than half of annual global mine production, trading in one day. Now, here's the critical thing to understand. The vast majority of these contracts, we're talking about 98 to 99%, never result in physical delivery. They're just paper being shuffled around. And this creates a situation where the price of silver is being determined not by the physical supply and demand dynamics I just described, but by the trading of these paper contracts. Let me tell you a story that illustrates this perfectly. Back in March of 2020, right when the pandemic hit, something extraordinary happened. The COMEX silver price crashed to about $12 an ounce. At the same time, if you tried to buy physical silver from a dealer, you couldn't find it for less than $20 an ounce, if you could find it at all. Think about that for a second. The paper price said silver was worth $12, but you literally could not buy physical silver for anywhere near that price. The disconnect was so severe that the US Mint had to suspend production of silver eagles because they couldn't source enough silver blanks. This disconnect between paper and physical markets has been growing for years, but it's accelerating now. And there are some very specific players who have a vested interest in keeping the paper price suppressed. Let's talk about who they are and why they're doing it. The biggest short positions in silver are held by a handful of large banks. And I'm not speculating here. This is public data from the CFTC, the Commodity Futures Trading Commission. These banks hold massive short positions, meaning they're betting that the price of silver will go down. Now, why would banks want to bet against silver? Well, there are a few theories, but the most compelling one has to do with the dollar. Silver, like gold, is a monetary metal. It's been used as money for thousands of years. When people lose confidence in fiat currencies, they tend to move into precious metals. And if you're a central bank, or if you're a large commercial bank that benefits from the current monetary system, you have a very strong incentive to keep precious metals prices suppressed. Because rising gold and silver prices are essentially a vote of no confidence in the currency system. But here's where we are right now. And this is the critical inflection point. The physical market is starting to overwhelm the paper market. We're seeing signs of this everywhere. The premiums on physical silver have been elevated for months. Delivery times are stretching out. The US Mint is rationing silver eagles. Refineries are running at full capacity and still can't keep up with demand. And then you've got what's happening in the ETF market. The big silver ETFs, like SLV, are supposed to be backed by physical silver. But there's been a lot of questions about whether they actually have all the silver they claim to have. And more importantly, we're seeing massive inflows into these ETFs from institutional investors. In the last year alone, silver ETFs have added over 100 million ounces. That's physical silver that has to be purchased and stored. Now let me shift gears for just a moment, because if you're sitting on $100,000 or more in retirement accounts, this next part is really important. A lot of people don't realize you can actually hold physical precious metals in a retirement account through what's called a gold IRA or silver IRA. I put together a comprehensive guide on exactly how this works, how to do it without triggering tax penalties, and what you need to know. It's completely free, and you'll find it in the description below. It's worth checking out if you're thinking about protecting a portion of your retirement savings with physical metals. All right, back to what's happening in the market right now. Because we need to talk about China, and this is where things get really interesting from a geopolitical perspective. China has been the world's largest producer of silver for years. They produce about 3,500 tons annually. But here's the thing. China is also the world's largest consumer of silver. They use more silver than they produce. And in the last 2 years, China has essentially stopped exporting silver. Think about the implications of that. The world's largest producer is keeping all of their production for domestic use. That means the rest of the world has to make do with less supply. And it's not just China. We're seeing resource nationalism pop up all over the place. Countries are starting to realize that these strategic metals are too important to just ship overseas. Peru, which is the second largest silver producer, has been dealing with social unrest and mining disruptions. Mexico, the largest producer, has been implementing stricter environmental regulations that are constraining production. Russia, which is a significant producer, is essentially cut off from Western markets due to sanctions. When you add all of this up, the available supply for Western markets is shrinking rapidly. Now, let's talk about what the smart money is doing, because this is always a tell. When you look at what major investors and institutions are actually doing with their money, as opposed to what they're saying publicly, you get a very different picture. We've seen billionaire investors like Eric Sprott accumulating massive positions in physical silver. Sprott has been one of the most vocal advocates for silver, and he's been putting his money where his mouth is, investing hundreds of millions into silver mining companies and physical silver. But it's not just individual billionaires. We're seeing family offices, which manage money for ultra-wealthy families, significantly increasing their precious metals allocations. These are sophisticated investors with access to the best research and analysis money can buy, and they're moving into silver in a big way. Here's something else that's fascinating. If you look at the insider buying in silver mining companies, it's been off the charts. CEOs and directors of these companies have been buying shares of their own companies with their personal money at levels we haven't seen in years. These are people who know the industry inside and out, who have access to all the data, and they're betting big on higher silver prices. Let me tell you about what happened in 2011, because there are some eerie parallels to what we're seeing now. In 2011, silver went from about $18 an ounce in the summer of 2010 to nearly $50 an ounce by April 2011. That's a move of almost 180% in less than a year. And what drove that move? It was a combination of factors that are remarkably similar to what we're seeing today. You had QE2, the second round of quantitative easing, which was flooding the market with dollars. You had concerns about sovereign debt in Europe. You had rising inflation. And you had a surge in investment demand as people looked for ways to protect their wealth. The physical market got so tight that premiums exploded and dealers couldn't keep silver in stock. Now, what's different this time? Well, the industrial demand picture is far stronger now than it was in 2011. Back then, solar was a tiny fraction of what it is today. EVs barely existed. 5G wasn't even on the horizon. The structural demand for silver is multiples of what it was back then. And the supply situation is actually worse now. In 2011, production was still growing. Today, it's declining. But here's the really important part. In 2011, when silver hit $50, the CME, the exchange that operates the COMEX, changed the margin requirements 5 times in 9 days. They made it so expensive to hold silver contracts that it forced a massive liquidation. The price crashed from $50 to $26 in a matter of days. It was a coordinated effort to break the rally. Could they do that again? Absolutely. But here's the difference. In 2011, most of the buying was speculative. It was traders and investors. This time, you've got real, structural, industrial demand that isn't going away, regardless of what happens with margin requirements. You can't change the margin requirements on a solar panel manufacturer that needs silver to build their products. Let's talk about the gold to silver ratio, because this is one of the most important metrics in the precious metals market. Historically, the ratio of gold to silver prices has averaged around 60 to 1. That means it takes 60 ounces of silver to buy 1 ounce of gold. Right now, that ratio is sitting around 85 to 1. Silver is historically cheap relative to gold. But here's what's really interesting. If you go back through history, whenever the gold to silver ratio gets this elevated, it doesn't just revert to the mean gradually. It tends to overshoot dramatically in the other direction. In 2011, the ratio got down to 31 to 1. In 1980, it briefly touched 17 to 1. If we see that kind of move again, and gold is at $2,000 an ounce, you're looking at silver prices of $65 to $120 an ounce. Now, I'm not saying that's going to happen tomorrow, but what I am saying is that the setup is there. The fundamentals are there, the technical picture is there, and the historical precedent is there. The question isn't if silver is going to have a major move higher. The question is when, and what's going to be the catalyst. Let me tell you what I think the catalyst could be, and this is based on watching these markets for years. I think we're going to see a delivery default on the COMEX. Here's how it would happen. You've got these massive short positions held by banks. At some point, enough longs are going to stand for delivery, meaning they're going to demand physical silver instead of just rolling their contracts forward. And the COMEX isn't going to have enough physical silver to deliver. We've already seen warning signs of this. In March of 2020, the COMEX had to change their delivery rules to allow for delivery of silver bars from London instead of just New York, because they were running low on physical inventory. That was an emergency measure, and it tells you that the physical market is much tighter than most people realize. When a delivery default happens, or even when it looks like it might happen, that's when you're going to see the paper price and the physical price completely disconnect. The paper price might stay suppressed through manipulation, but the physical price is going to explode. And at that point, if you don't already own physical silver, you're not going to be able to get it at anywhere near the paper price. Here's another angle that most people aren't considering. The banking system is increasingly fragile. We saw what happened with Silicon Valley Bank and the regional banking crisis last year. That was a warning shot. The Fed had to step in with emergency measures to prevent a full-blown banking panic, and the underlying issues that caused those problems haven't gone away. They've just been papered over with more liquidity. When people lose confidence in the banking system, they move into tangible assets. And silver, being more affordable than gold, tends to see even more dramatic moves during these periods. In 2008, during the financial crisis, silver initially crashed along with everything else. But then, from its low in November 2008 to its high in 2011, silver went up over 400%. Gold went up about 150% during the same period. Silver outperformed gold by a massive margin. Now, let's talk about something that's happening right now that very few people are paying attention to. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several other countries that are joining, are working on creating an alternative to the dollar-based financial system. And a key component of this system is going to be backed by commodities, including precious metals. China and Russia have been accumulating gold at record rates, but there's also been significant accumulation of silver, particularly by China. If the BRICS nations launch a commodity-backed currency or trading system, it's going to create massive demand for precious metals. And silver, being more abundant and more affordable than gold, could play a significant role in this new system. Think about what that means. You're talking about countries representing over 40% of the world's population, potentially creating a new monetary system that requires physical precious metals. The demand implications are staggering. And this isn't some far-off possibility. This is actively being worked on right now. Here's something else that's fascinating from a technical analysis perspective. Silver has been consolidating in a range for the last few years. It's been building a base. And if you look at the chart, it's forming what technical analysts call a cup and handle pattern. This is one of the most bullish continuation patterns in technical analysis. When silver breaks out of this pattern, the measured move suggests a target of over $50 an ounce. But technical analysis aside, let's talk about the real-world implications of what's happening. If you're someone who's concerned about inflation, about the devaluation of the dollar, about the stability of the financial system, silver offers something that very few other assets can provide. It's a tangible store of value that has industrial utility, that can't be printed or created out of thin air, and that has been recognized as money for thousands of years. And here's the thing that makes silver particularly interesting compared to gold. Silver is affordable. You can start building a position in silver with a few $100s. You can't do that with gold. This makes silver accessible to a much broader range of people. And when you have millions of people around the world all trying to acquire physical silver at the same time, even small individual purchases add up to massive demand. We're already seeing this play out in real time. The retail investment demand for silver has been surging. Sales of silver coins and bars have been at record levels. The U.S. Mint sold over 30 million silver eagles last year. That's physical silver being taken out of the market permanently by individual investors. And this is happening all over the world, not just in the United States. Let me tell you about what's happening in India, because this is a market that doesn't get enough attention. India has traditionally been a massive consumer of gold, but in recent years, we've seen a significant shift towards silver. Why? Because silver is more affordable, and the Indian middle class is growing rapidly. These are people who want to own precious metals but can't afford gold, so they're buying silver. And we're talking about a country with over 1 billion people. The same thing is happening in other emerging markets. As the middle class grows in countries like Indonesia, Vietnam, Thailand, and across Africa, you're seeing increased demand for silver as a store of value. This is a long-term structural trend that's just beginning. Now let's talk about the mining side of the equation, because this is critical to understanding the supply picture. Silver mining is not a particularly profitable business at current prices. Most primary silver miners, companies that mine silver as their main product, are barely breaking even or losing money at prices below $25 an ounce. And even at $30 an ounce, the margins are thin. What this means is that there's very little incentive to invest in new silver mines. It takes years and hundreds of millions of dollars to bring a new mine into production. And if you're a mining company looking at the current price environment, you're not going to make that investment. So even if silver prices go significantly higher, it's going to take years before new supply comes online. And here's the kicker. The easy silver has already been mined. The ore grades at existing mines are declining. That means miners have to process more rock to get the same amount of silver. This increases costs and makes mining less profitable. It's a vicious cycle that's putting downward pressure on supply. Meanwhile, existing mines are depleting. The average silver mine has a life of about 10 to 15 years. Every year, mines are closing because they've exhausted their reserves. And they're not being replaced fast enough by new mines. This is why production has been declining despite higher prices. Let me paint you a picture of what I think is going to happen over the next few years. We're going to continue to see industrial demand grow as the green energy transition accelerates. We're going to see investment demand increase as more people wake up to the inflation and currency devaluation that's happening. We're going to see supply continue to decline, or at best, stay flat. At some point, probably sooner than most people expect. The physical market is going to get so tight that the paper manipulation becomes impossible to maintain. When that happens, we're going to see a price spike that makes 2011 look tame, and the people who positioned themselves ahead of time are going to do extraordinarily well. But here's what I want you to understand. This isn't about getting rich quick. This is about protecting your wealth and positioning yourself for a major shift in the monetary system. Silver isn't just for preppers. It's for anyone who's paying attention to what's actually happening in the world and who wants to take steps to protect themselves. The smart money is already positioned. The institutions are accumulating. The billionaires are buying. The question is, are you going to wait until everyone else figures it out and the price has already moved? Or are you going to take action now, while silver is still affordable and available? Because I can tell you this with absolute certainty. There's going to come a time, probably in the not-too-distant future, when you're going to wish you had bought silver at today's prices. The setup is there. The fundamentals are there. The only question is whether you're going to act on it.